Hello, so my name is David Andolfatto. I'm with the Federal Reserve Bank of St. Louis in the Research Division, and we are here at the 39th Annual Fall Conference. With me today is Professor V.V. Chari of the University of Minnesota and the Federal Reserve Bank of Minneapolis. Chari will be speaking about a paper with the title of On the Optimality of Financial Repression, and he's kindly agreed to join us today to tell us in lay terms just what his paper is all about. So why don't you start, Chari, by defining what you mean by, this is a very provocative kind of title, On the Optimality of Financial Repression. What do you mean by repression?
It's a pleasure to be here. Financial repression is a term that's often used to describe policy measures by governments which require, in particular banks, but more generally other intermediaries like savings and loans, insurance companies, and pension funds and the like, to hold a lot of government debt in their portfolios. That is, that besides private assets that they might hold, like loans to households, mortgages, and so on, they're often required to hold a lot of government debt.
So would a required reserves on the part of banks, for example, constitute a form of financial repression, kind of a legislated amount of a certain type of government assets?
Right. So typically these are requirements that in order for the bank, typically it's justified in terms of safety and soundness. It says that in order for a bank to meet its regulatory standards, it must hold a sufficient amount of so-called safe assets. These safe assets typically refer to the debt of the government where this entity is located.
And so the repression refers to the fact that these entities are required kind of against their will to hold these types of assets, I presume. So what is the question that you're interested then in addressing in this paper?
So historically, this issue has largely been studied within the context of ensuring that banks particularly continue to be safe. But we take a somewhat different perspective on this. We look at the broad sweep of historical experience, and oddly enough, it turns out that whenever governments need to issue a lot of debt, the United States during the Civil War is one example of this. More recently, we've seen this need in Europe. Whenever they need to issue a lot of debt, that's when implicit or explicit regulations requiring financial intermediaries to hold debt seem to go up. And these banks and similar institutions end up holding a large fraction of their portfolio in the form of government debt. So that we thought was a striking and interesting observation. And so we were led to ask why. And what we argue in our paper is that this phenomenon is very hard to understand if governments can, in technical terms, commit to their future policies. So what that means is that if a government can choose what policies it's going to follow for a long period of time and stick to those policies, then requiring banks to hold this kind of debt is a very inefficient way of raising revenue. There are much more efficient ways of raising the revenue needed to finance a war or issuing government debt during a recession. Precisely because forcing banks to do this implies that banks will be able to finance less private investment, and so therefore the economy will be worse off as a consequence of these policies. However, what we argue is that in a world where people are concerned about the possibility that governments might default on their debts, either explicitly or implicitly through inflation, then these policies remarkably start to make sense. And they make sense because if banks and other intermediaries are holding a lot of public debt, then a default endangers the financial system and therefore tends to make the situation a lot worse. And because the situation is going to be a lot worse, governments are dissuaded from defaulting. And so therefore, from the perspective of governments looking ahead, this mechanism turns out to be a useful device to commit yourself not to default in a world where it's difficult to convince investors that you will not default on that debt. So paradoxically, something that turns out to be very bad, if governments can pick policies and stick to them, turns out, in fact, to be a necessary and a desirable instrument in a world without commitment.
Huh. Okay, so it's what you're saying is basically that in a world where the government cannot commit to its promises, say to repay debt, that if it forces the domestic banks to overload on the domestic sovereign debt, that this would increase the cost, the economic and presumably political cost of the government from defaulting. And the threat of that is what enhances the ability of the government to better finance?
That's exactly right. And so these forces are likely to be particularly strong when the government needs to issue a lot of debt, because when they issue debt, investors will buy the debt only if they think that the government is unlikely to default. But if you've got a situation in which you've already fought a war, think World War II or something like that, and you've issued a lot of debt during the war, come peacetime, you have a strong incentive to say, well, let's default in part on that debt through inflation or through explicit kinds of means. How does that help you? That means that valuable resources, which would have been used to finance other kinds of expenditures, no longer have to be used to pay interest on government debt, and so therefore the distortions that occur because you've got this big overhang of government debt is much smaller.
I see. So presumably this is not the only way government could build commitment. I mean, or to enhance its commitment to repay. There are also political costs to, say, consumers and households who would be loaded up on this domestic debt. I guess in your paper you don't actually focus on that. You're focusing on the costs potentially through the banking sector, not the political costs?
No, we wanted, like any good paper, we hope, we wanted to focus on one issue rather than take on a whole gamut of issues. And so we chose to isolate our attention, focus our attention on this particular issue rather than discuss the broader ramifications. I have a bunch of papers which address those broader ramifications as well.
Well, let me then ask you, let's come back to the evidence that's motivating the inquiry, and in particular the recent events in Europe. You mentioned, and I think it's pretty well known, that it seems unusual that, say, Italian banks seem to be loading up disproportionately on Italian sovereign debt, or, I mean, it's this type of phenomenon that you're talking about. You know, we don't necessarily see any explicit government regulations requiring these banks to behave in this manner. Could it be that there are natural market forces that would lead, say, Italian banks to load up on Italian debt?
Yes, there are some market forces. The nature of regulation is a little complicated and a little subtle. Because especially as far as the banking system is concerned, private banks are in fairly close touch with their regulators. And their regulators evaluate the safety of these banks through a variety of different kinds of metrics. It's not just specific written down formulas. And so we think of a lot of this kind of regulation as being implicit, not quite out in the forefront, not in any specifically in any written rule or regulation. But yes, there are perhaps other forces that would lead banks, Italian banks, to load up on Italian government debt. Those forces tend to be weak because banks do have, in a reasonably competitive market system, have strong incentives to diversify their portfolios. And so therefore, holding Italian government debt is a particularly undiversified form of risk if you're holding a lot of Italian mortgages or loans to Italian firms, because that debt is going to become relatively less valuable exactly when the rest of the Italian economy tanks. So normal market forces, you'd think, would give Italian banks a strong incentive to hold German debt and German banks to hold a lot of Italian debt. Instead, we tend to see in practice the exact opposite.
Well, let me describe what I had in mind in terms of natural market forces that kind of I think are maybe complementary to your story. Suppose for whatever reason the Italian banks feel that the Italian government is less likely to default on their sovereign debt that's held domestically. So that and suppose this is true throughout Europe, so that by natural market forces, I mean there would be natural market forces for this debt. You'd like it to be diversified, but if what I just said was true, this sovereign debt would be relocated to kind of its domestic sources, because that it kind of reinforces your paper. This is not through explicit government regulation, but they know that the government is less likely to default if it's held domestically. I mean,
right. No, I think that is very complementary. One can certainly imagine those kinds of forces inducing banks to understand that it's in everybody's cooperative and best interest to hold a lot of Italian debt. So I agree. I think the kind of story you're telling complements the story we're telling fairly well.
Okay, very interesting. So, in terms of like policy implications, I mean, if what do you feel are the main lessons that policymakers might draw from the findings of your research?
So, a very pressing and central topic in Europe, for example, right now, is that the plan is that the European Union will have a central regulatory and supervisory authority, which will be run perhaps out of the European Central Bank in Frankfurt and in Brussels. And that authority will have the primary responsibility for supervising all the banks from Portugal to Ireland, to Germany and Austria. As opposed to the current practice, which is that the national regulatory authorities regulate their own domestic banks. And an important issue that's being discussed as we speak is how should these regulations be set up? And there are lots of forces in Europe arguing on very sensible grounds that, that national banks in Portugal, for example, should not hold an excessive amount of Portuguese debt that makes them vulnerable to the possibility that Portugal might default on its debt. And so therefore, they should be induced or required to hold German debt, for example. And there are good reasons why you might think that that proposal is a good idea. What our research suggests is maybe not so fast. Maybe there are good reasons why Portugal or Greece or Italy or Spain might require their own banks to hold their own national debt. We should take those considerations into account in designing policy. Far be it from me to suggest that the considerations we're pointing out are the only ones that should guide regulation, but we think it is an important, perhaps very important consideration that they should keep in mind. So maybe the European Supervisory Authority should think twice before it harmonizes regulations across Europe.
Very good. Well, thank you very much, Chari. Do you think that, can you give us a brief takeaway? If in a couple of sentences, what would you say is the main point of your research?
Sure. Good economics always has, I think, the property that things that seem like a puzzle on the surface, through deeper analysis, turn out to be less of a puzzle. And I think that our paper exemplifies that. Good applied economics has useful and interesting policy recommendations, and I hope our paper has that as well.
Thank you very much. There you go. Recommendation for financial repression in Europe coming out of Minnesota. Thank you, Chari.
Thank you, David. It's a pleasure.